Right now, as you are watching this, there's a tsunami of capital, $650 billion to be exact, being pumped into a single industry by just 4 companies. That is a billion with a capital B. This isn't just a tech trend or a flashy headline. Where that money lands, and more importantly, where it does not land, is going to be the single biggest factor in whether your portfolio thrives or vanishes into thin air over the next 12 months. But while the headlines are screaming about the future of intelligence, Wall Street's biggest bank has quietly released a secret list. This isn't the stuff they talk about on CNBC. This is an internal list of stocks they believe are completely mispriced and, more importantly, insulated from the very disruption everyone else is terrified of. They didn't send this list to retail investors. They didn't send it to your financial advisor. They sent it exclusively to their large institutional customers. Later in this video, I'm going to show you exactly what is on that list, because I believe you deserve to see the same data the elites are using to protect their wealth. Now, you might be sitting there with an index fund in your 401k, hoping for the best, thinking the market is stable because the S&P 500 is holding steady. But I have to tell you, the rules of Wall Street have just changed, and most people have absolutely no idea. You see, we are living in what I call a financial Truman Show. The script says everything is fine, the banks are talking about strong loan pipelines, and the Treasury Secretary is calling for a blockbuster 2026. But if you look behind the curtain, consumer sentiment is in the toilet. And the average American household is paying an extra $1,300 a year just to keep up with new tariffs. So how is it possible that the economy hasn't crashed yet? Why is the market flat instead of cratering? There are 3 invisible pillars, 3 massive scaffolds, holding this entire building up. If even one of these pillars cracks, the floor drops. But there is one pillar in particular, the 3rd one, that no one is talking about publicly. It involves a secret button the administration is holding that can pause a market crash in 90 seconds. But here is the danger. What happens if they hit that button and nothing happens? We will get to that suicide switch in a moment, but first, we have to look at the sheer scale of the money being burned. Let's talk about pillar number 1. We aren't talking about chatbots writing your emails anymore. We are talking about Microsoft, Amazon, Alphabet, and Meta spending more than $600 billion this year alone on AI infrastructure. To put that into perspective, that is more than the entire gross domestic product of Sweden. Every cracker bread, every car, every piece of furniture that entire nation produces in a year is less than what 4 guys in Silicon Valley are spending on microchips and data centers. Goldman Sachs says this matches the 1990s telecom investment boom. Now, if you remember how that ended, you should be sweating right now. These companies are calling it as generational opportunity, which is banker speak for we have no idea if this will ever pay off, but if we don't spend the money and our competitors do, we are toast. This is a cycle of forced spending that accounted for 40% of gross domestic product growth last year. But this creates a massive risk that almost no one is pricing in, concentration fragility. When 4 companies are the only thing keeping the lights on in the American economy, what happens when they decide they've bought enough chips? JP Morgan AS internal data shows that a very specific trade, buying semiconductor stocks and shorting software companies, has already made 35% this year. But both of those sectors have now reached what we call historical extremes. This is where the opportunity lies. When things reach an extreme, they snap back. The smart money isn't buying the hardware anymore. They are looking at the software companies that are currently lying on the floor, bleeding and beaten to within an inch of their life. But you can't just buy any software company. Many of them actually are going to die. The secret list I mentioned earlier identifies the ones that are AI-proof. But before we can look at those specific stocks, we have to answer a much more uncomfortable question. If the economy is being propped up by $600 billion in tech spending, why does the average person feel like they are drowning? Why is there such a massive gap between the stock market and your bank account? The answer lies in the 2nd pillar, and it involves a statistic about the top 10% of Americans that is both impressive and terrifying for the future of the middle class. If you think the wealth effect is just a theory, wait until you see what is happening to consumer spending right now. It is the only reason we aren't in a deep recession today, but it is also creating a trap that could snap shut by the end of this year. We just touched on the staggering amount of money tech giants are pouring into the system, but that only explains one side of the ledger. It explains the supply side of the economy. But for an economy to actually function without collapsing, someone has to be buying. Someone has to be swiping plastic. And this is where we find the 2nd pillar holding up this financial Truman Show, and frankly, it is the most lopsided statistic in modern economic history. Did you know that the top 10% of American households are now responsible for driving half of all consumer spending in the entire United States? Think about that for a second. 10% of the population is carrying 50% of the weight. This is a record and not the kind you want to celebrate. Consumer spending is the absolute lifeblood of the United States economy. It represents more than 2/3 of the entire gross domestic product. So, when the government and the Treasury Secretary stand up and shout about a blockbuster 2026, they aren't looking at your bank account or mine. They are looking at the portfolios of the people who own the assets. This is what economists call the wealth effect. It is a psychological loop. When the stock market stays flat or edges higher, and when home values continue to climb because of a lack of inventory, the people who own those stocks and homes feel rich. And when people feel rich, they spend money. They buy the new car, they book the luxury holiday, and they upgrade the kitchen. That spending shows up in the official data as economic growth, which gives the Federal Reserve and the government the cover they need to say the economy is resilient. But here is the open loop that should make you very nervous. What happens when the top 10% stops feeling rich? We are seeing the data right now. While the top tier is increasing their spending by 10% year over year, the spending by lower and middle income households is actually in a state of decline. The middle class is being inflated away. They are paying more for eggs, more for insurance, and more for energy, which means they are buying fewer things. The economy is currently a two-speed engine. One half is screaming at 200 miles per hour, and the other half has a blown head gasket and is smoking on the side of the road. As long as the fast half stays fast, the engine keeps turning. But JP Morgan's internal notes have flagged a specific saturation point for this wealth effect. There's a specific number, a level on the S&P 500, that, if breached, would cause the top 10% to stop spending overnight. If that happens, the 2/3 of our economy, driven by the consumer, doesn't just slow down, it vanishes. Now, I promise to tell you why this might not be good news for the average American. It is because we are living in a system that is fundamentally unfair. If you have capital, you are invited to the party. If the government pumps the market to keep the wealth effect alive, your net worth goes up. But if you are working for a wage, you are watching the cost of living rise while your purchasing power shrinks. You are getting proportionately poorer every single day the market stays stable. You might be wondering, why doesn't the government just fix this? Why don't they lower the costs for the average person? Well, that brings us to the most controversial part of this entire deep dive. There is a theory circulating on the trading floors of banks like Goldman Sachs and JP Morgan. It is a theory about a backstop button, a literal policy tool, that the current administration uses to keep the market from tanking whenever it gets close to a danger zone. We saw it happen in 2025. Do you remember when the tariffs were announced and the market started to freak out? The S&P 500 began to slide and it looked like the big one was finally here. Then, suddenly, a 90-day pause was announced. The market didn't just stop falling. It posted its biggest daily gain since the financial crisis of 2008. This wasn't an accident. This was a calculated move to protect political approval ratings by protecting the stock market. But here is the terrifying question that Wall Street is whispering about behind closed doors. Is this backstop button actually making the eventual crash worse? By preventing the small fires? Are they just piling up the dry brush for a massive forest fire that no one can put out? And more importantly, there is a black swan event scheduled for later this year that could take the backstop button completely offline. Most people think the biggest risk to the market is interest rates or inflation. They are wrong. The biggest risk is a specific shift in the institutional liquidity cycle that is set to happen in the next 3 months. If you don't know what that cycle is, you are essentially flying a plane in a fog bank without a radar. Before we reveal that liquidity trap and the third pillar that is currently acting as the economy's suicide switch, we need to look at the list. I told you JP Morgan has a basket of stocks they are buying right now, stocks that they believe are mispriced. These aren't just random companies, they are the businesses that provide the picks and shovels for the AI revolution without being exposed to the AI hype. If you are worried about AI taking your job or destroying your tech stocks, you need to see how the smart money is positioning themselves. They aren't buying the flashy robots. They are buying something much more boring and much more profitable. We are talking about financial infrastructure and cyber defense. But why these sectors? Why is JP Morgan betting billions on companies that help other businesses manage their data, rather than the companies creating the data itself? The answer involves a concept called attack surface expansion. As AI creates more data and more automation, it creates more ways for things to go wrong. It makes hacking easier and more frequent. Therefore, the walls have to get taller. Well, everyone else is betting on who will win the AI race. The banks are betting on the companies that build the stadium and the security for the race. But even these safe stocks are vulnerable if the third pillar fails. But this third pillar is psychological, but it is more powerful than any bank balance or interest rate cut. It is the belief in the floor. It is the collective delusion that someone will always step in to save us. But what happens when the someone, the government or the Fed, runs out of bullets? What happens when the backstop button breaks? There's a specific date on the calendar. tied to the upcoming midterms and a change in the Federal Reserve leadership, where the psychological floor could vanish in a single afternoon. If you are positioned for a blockbuster 2026 and that floor disappears, you won't have time to sell. So we have to look at the third pillar, the policy release valve. We have to understand the Truman Show script for the next 6 months. Because if you know the script, you can see the ending before the rest of the audience. We are going to break down exactly how the smart money traders are preparing for the moment the backstop fails, and why they are currently scrambling to get their hands on one specific asset that has nothing to do with tech, AI, or the United States dollar. Can you guess what it is? It is the one thing every central bank on the planet is buying in record quantities right now, and it isn't Bitcoin. We will reveal that ultimate hedge in the final piece of the JP Morgan list in the next section. But first, let's look at the obsolescence narrative that is currently driving software stocks into the dirt, and why JP Morgan thinks this is the greatest buy the dip opportunity of our lifetime. If, and only if, you know which companies are actually going to survive the transition. We have looked at the massive corporate spending and the top-tier consumer wealth keeping this financial Truman Show on the air. But now, we have to look at the third and final pillar, the one that acts as the economy-S policy release valve. This is the psychological safety net that tells investors, don't worry, the government won't let it fail. But there is a major change coming to that safety net. In just a few months, the leadership of the Federal Reserve is shifting. Jerome Powell's term is ending in May, and the nomination of Kevin Warsh represents a seismic shift in how the backstop button will be used. Warsh is known as a triple threat elite, a man who has navigated Wall Street, the White House, and the Fed. His strategy is something the markets are calling front-loaded rate cuts combined with active tapering. This is the open loop that is keeping professional traders awake at night. What happens to a market that is addicted to cheap money when the new sheriff in town decides that money printing was an emergency tool that has overstayed its welcome? Warsh has publicly stated that excessive liquidity erodes public purchasing power. If he pulls back on that liquidity while the middle class is already struggling, we could see a regime change in the markets that renders your current strategy obsolete by midsummer. However, while the macro picture looks like a minefield, JP Morgan's trading desk is doing something very specific. They aren't running for the exits. They are repositioning into what they call the insulated basket. These are companies that are mispriced because the market is too stupid to realize they aren't actually threatened by AI. They are fueled by it. Let's look at the names. In the tech sector, they are doubling down on CrowdStrike, Palo Alto Networks, and Zscaler. Why? Because of a concept I mentioned earlier, attack surface expansion. Every time a company adds a new AI tool, they add a new door for a hacker to walk through. The more AI we have, the more cybersecurity we need. These aren't just software companies. They are the digital border patrol. But the real shocker on the list isn't a tech company at all. It's C.H. Robinson Worldwide. This is a freight brokerage company that the market absolutely hammered recently, dropping 15% in a single day because of fears that a new AI trucking platform would automate them out of existence. But JP Morgan is calling this a disproportionate sell-off. They see C.H. Robinson's unrivaled data and deep customer connections as a competitive moat that no line of code can replicate overnight. They are betting that the obsolescence narrative has been overcooked. They are also looking at TPG, the asset manager. While other firms are loaded with risky software startups, TPG actually reduced its software exposure years ago. JP Morgan believes TPG is at the top of the list for intelligent technology investing because they didn't get caught in the hype cycle. And then there's the real estate play. Compass. The market is terrified that AI will replace real estate agents. But JP Morgan disagrees. They argue that local expertise, negotiation, and human client services are the core of the business. Code can find you a house, but code cannot negotiate a better price or navigate a complex closing. But even with this insulated basket, there is one danger that could wipe out these gains in an instant. It is the institutional liquidity trap I mentioned. Right now, there's a specific date on the calendar where the liquidity provided by the backstop button is scheduled to reset. If the new Fed leadership shifts too fast, the carry trade could implode, leading to a leverage purge that would make the October correction look like a walk in the park. This is why the smart money, the central banks in China, India, and even the European Central Bank, is quietly moving into the ultimate hedge. They are buying gold at record rates, adding over 1,000 tons annually. They aren't doing this because they like shiny metal. They are doing it because gold is a strategic bet against the very backstop button we've been discussing. It is an asset that cannot be frozen, sanctioned, or devalued by a central bank's policy shift. So, here's the final piece of the puzzle. You have the three pillars, AI spending, the top-tier wealth effect, and the political backstop. You have the JP Morgan list of insulated stocks like CrowdStrike and C.H. Robinson. But if you don't understand the liquidity cycle that is about to flip, you are still gambling. What if I told you there's a way to see exactly when the smart money is entering or exiting these trades? These aren't my rules. These are the rules taught to me by mentors who ran the desks at Goldman Sachs and JP Morgan. I'll show you how to spot the institutional fingerprint on a stock chart so you don't have to guess if a dip is a buying opportunity or a falling knife. Be on time, because in this financial Truman Show, the people who are late to the scene are usually the ones who end up paying for the production.